Hello everyone. Today we will discuss about strategic market planning. As we all know that successful companies know how to adapt to a continuously changing marketplace. They practice the art of market-oriented strategic planning. Market-oriented strategic planning is the managerial process of developing and maintaining a viable fit between the organization's objectives, skills, and resources and its changing market opportunities. The aim of strategic market planning is to shape the company's businesses and products so that they yield target profits and growth. Therefore, we call for actions in three key areas with respect to strategic market planning. Number one is managing the company's businesses as an investment portfolio. Number two, assessing each business strength by considering the market's growth rate and the company's position and fit in that market. And number three, making an appropriate strategy for the products and services which the company is planning for the future course of action. Therefore, we will go for strategic marketing planning as all the corporate headquarters undertake four marketing planning activities. Number one, defining the corporate mission. Number two, establishing strategic business units, SBUs. Number three, assigning resources to each strategic business units in terms of manpower, capital, inventories, and various other resources. And number four, planning new businesses and downsizing older businesses which are not giving the expected profitability to the firm. An organization must have a clear and specific mission. First of all, it is mandatory as the good mission statement have three major characteristics and it focuses on a limited number of goals. The mission statement also stresses the major policies and values that the company wants to honor in terms of customers and stakeholders, and defining the major competitive scope within which the company will operate. The mission statement are at their best when they are guided by a vision and almost impossible dream that provides a direction for the company for the next 10 to 20 years. Therefore, most of the companies operate several businesses. They often define their businesses in terms of products, but according to Levitt, a business must be viewed as a customer satisfaction process, not as a product development process. And the products are transit, but basic needs and customer group endure forever. The business can be defined in terms of three dimensions. Number one, customer groups. Number two, customer needs. And number three, the technology which the company is planning to inculcate. The characteristics of its SBU are, it is a single business or a collection of related businesses that can be planned separately from the rest of the company. Number two, it has its own set of competitors. And number three, it has a manager who is responsible for strategic planning and profit performance and who controls most of the factors which affects the profits. The assigning resources to each SBU. The purpose of identifying the company's strategic business unit is to develop separate strategies and assign appropriate funding to each and every strategic business unit. The managers need some analytical tools for classifying their businesses by profit potentials. There are two models which we can also say analytical tools that are best known models for portfolio analysis of any particular business. These two tools are the portfolio analysis. One of the tools used in analyzing market scenarios and strategic decisions concerning product mix is the portfolio analysis. For analyzing the portfolio, we have two different tools. Number one is known as the BCG model, the Boston Consulting Group's model, And number two is the GE approach, which is the General Electric approach. The BCG model assumes a market growth rate of 10% as the cutoff point. The market share is expressed in log scale and 1.0 is taken as the cutoff point. We have divided this BCG model into four different columns. Number one is known as STAR, means a strategic business unit, which we are considering as a star performer. Number two is the problem child. Problem child means any strategic business unit of a company which is not providing sufficient or expected amount of revenues continuously. Number three is the cash cow. Cash cow means any strategic business unit which is producing or manufacturing or providing any product or services to the market for a short term, but they are generating sufficient or substantial amount of profit. And number four is the dog. Dog means those strategic business units which are continuously performing very poor in terms of profitability, in terms of market share or product development. Now we will take them one by one. BCG matrix is simply horizontal axis is the relative market share shown in a log scale. The vertical line is usually set as 1.0 relative market share, and SBU is the left of the line, means it is the market leader in the industry or segment in which it operates. Conversely, an SBU to the right of the line, 1.0 relative market share means it is not the leader or it is not the market leader. Then we have the vertical axis. The vertical axis is the growth rate. 5 levels may be used. Number one is product, number two is product lines, number three is market segments, number four is SBU, and number five is business growth rate. The horizontal line is usually set as 10% growth rate. SBU above the set value, that is the 10% line, represents high growth rates, and conversely, SBU below this value depicts slower growth rate of any strategic business unit. Now, we will come to one by one for each and every block. First of all, question mark. Question mark is also known as the problem children's. There we have, in terms of investment, heavy initial capacity expenditure and high research and development cost is involved. The earnings are negative or very low. Therefore, the company has to think about it. The cash flow is also negative, net cash user. Now, the strategy implication for question mark or problem children is, if possible, to dominate segment, go after share. If not, redefine the business, or we can simply withdraw from the market so that you don't have to invest further in terms of capital, in terms of technology, or in terms of manpower. Then we have star. Star means in terms of investment, it continues to invest for capacity expansion because stars are performing very well in the market and they are generating substantial amount of profitability. In terms of earning, low to high earning rate is there. And in terms of cash flow, negative cash flow or net cash user, the strategic implementation for star is we can continue to increase the market share even at the expense of short-term earning, because as we already told that star means these are the strategic business units which are earning substantial amount of profitability but for only short-term duration. Then we have cows, which we also call as the cash cow. Cash cow means in terms of investment, the capacity is maintenance, earning is very high, cash flow is positive. Therefore, the strategic implications for cash cow is we can simply maintain market share and cost leadership until further investment becomes marginal. Then we have one more strategic business units which we call as dogs. Dogs means in terms of investment, they gradually reduces the capacity. earning is high to low, cash flow is positive, net cash contributor if deliberately reducing capacity. The strategic implications are plan an orderly withdrawal to maximize cash flow, because we are already knowing that dogs are not performing very well in the market for a continuous process. Then we have three paths to success in terms of BCG metrics. Number one, continuously generate cash cows and uses the cash throughout by the cash cows to invest in the question mark that are not self-sustaining. Then star needs a lot of reinvestment. As we are saying, they are stars. So we have certain other methods in terms of BCG metrics analysis, which become a path to failure also. Over-investment in cash cow or under-investment in question mark. The trade further opportunities for present cash flow. Then under-investment in star allows competitors to gain share in a high growth market, and over-milking of cash cow is also sometimes becomes hazardous for the company's strategic business units. Therefore, what we can do is simply go for another approach to analyze the portfolio of any strategic business unit. We have another method to analyze the portfolio, that is known as the General Electric approach. Now, before taking General Electric approach or the GE approach, I would like to tell you that the problem with BCG model is that the cutoff point taken on the market growth rate to classify high growth and low growth market as arbitrary, and in most cases 10% is too high a growth rate. To overcome this problem and also to consider factors contributing to market growth and share, the General Electric approach comes to handy. Therefore, it is much more better to take General Electric for analyzing the strategic business units. Now, the GE model has again 9 cell metrics. The y-axis depicts market attractiveness and the x-axis depicts the firm's strength. We have divided in terms of high, medium and low on x-axis as well as the y-axis. To make it more approachable, we have divided these 9 cells into 3 different colors. The first 3 colors are in green, the middle columns are yellow, and the last 3 columns are in red color as per the performance of the strategic business unit. The market attractiveness is measured by factors like market size, annual growth rate, competitive intensity, rate of technological development, government policies, and influence of other interest groups. Then competition is also taken care of by certain factors like market share, annual growth in market share, customer loyalty or brand loyalty, product quality, brand image, distribution network, productivity, research and development initiatives taken by the company, and the financial positions, etc. Then we have certain other factors also, like on examining the product portfolio of a firm, one may find that some strategic business units or the products may fall in green segment, some in yellow segment, and some in the red segment. The SBU or product in green segment requires to be developed and supported. In yellow segment, it requires to be monitored carefully, and in red segment are to be harvested or divested for obvious reasons of moderate to weak competitive position in an unattractive market. Thus, in evaluating the product mix of a firm, we have to examine each product or product line from the point of view of market attractiveness and its competitive position in the relative market. Therefore, we will take it one by one. First, we have to identify the strategic gap, because we are taking care of winning market through market-oriented strategic planning. The strategic gap means the y-axis reveals the sales and the x-axis, that's about the time in terms of years. We have certain desired sales with the help of which we can generate expected amount of profits. And taking care of the current portfolio, we can go for three types of strategic planning. Number one is diversification growth. Number two is interactive growth. And number three is intensive growth. These can be the three strategic planning gaps which the company may think of. Intensive growth opportunities, integrated growth opportunities, and diversification growth opportunities. Now, identifying the opportunities to achieve growth within the company's current business, ENSOF has proposed a useful framework for detecting new intensive growth opportunities called a market or product expansion grid. The market or product expansion grid is simply divided into four different columns, and on the x-axis we have current market and new market, and on the y-axis we have current products and new products. When we are taking the current product in the current market, we can go for market penetration strategy. When we are dealing in the current product, but we are in the new markets, or we are planning to enter in the new markets, we can go for market development strategy also. When we have new product, but these new products we are selling in the current market, we can go for product development strategy that will give us positive results. And when we have new product and new market, we can go for diversification strategy, and this is the best fit as per ENSOF. Now, the strategic planning with respect to General Electric model, it is the management task which is concerned with the growth and future of business enterprise, and it provides a route map for the firm and helps to take decision in the future with greater awareness. The BCG and G matrix, as we can see, has certain differences which we can see here with the help of diagrams. Actually, the BCG matrix is simply taking care of four different aspects only, but the General Electric model is taking care of 9 different possibilities or opportunities. So we can say that the General Electric model provides us much more opportunities for analyzing the strategic business unit. The General Electric matrix was developed by McKinsey & Company in 1970s. GE is a model to perform business portfolio analysis on the SBU. GE is rated in terms of market attractiveness and business strength, and it is an enlarged and sophisticated version of Boston Consultancy Group's matrix. The BCG matrix is divided, as we have already told, is divided into 9 different cells having different color combination as per the performance of the strategic business units. And these colors also reveals what type of strategy we have to adopt when we are dealing with different strategic business units in terms of their product, in terms of their profitability, as well as in terms of their market attractiveness. The General Electric model also reveals the annual market growth rate, overall market size, the historical profit margins of the strategic business units, current size of the market, market structure, market rivalry, who is the competitor, what type of competition is prevailing in the market, whether the competition is within the SBU or outside the SBU, the demand variability, as well as what are the global opportunities for existing products and services which the strategic business unit is dealing with. Similarly, the business strength is also taken care of. What is the current market share, the brand image of the company, brand equity, production capacity of the firm, corporate image in terms of stakeholders and the consumers, profit margins relative to competitors, research and development performance of the strategic business units, managerial personnel, and the promotional effectiveness of the strategic business units for its various products as well as the services. Now, coming on to the strategies of the General Electric model, we will take them one by one. First, we will go for the green colors. Means starting from the top, green. Now, when we are taking care of this green color, we can make different types of strategies. First is protect the position. Protect the position means when we are performing very well in the market, our best strategy is we have to protect the position, or we have to protect our current position in the market. We have to invest to grow, as well as we have to make efforts on maintaining the strength of the strategic business units. Number two, we have to invest to build. Invest to build means challenge for leadership, as well as build selectively on strength. Then build selectively means we have to invest in most attractive segment. Whenever we are planning for further investment in strategic business unit, we have to identify which segment is most attractive. Then only we will be having more profitability or revenues from the market. Then build up ability to counter competition. We have to take care of the competition or the rivalry also. Then emphasize profitability by raising the productivity of the strategic business unit. These are some of the strategies which we have to inculcate when we are taking care of the first three green colors or three columns. Now, coming on to the yellow one, means the middle one, we have some different strategies when we are taking care of these yellow columns. Now, starting from the lowest yellow corner, the best strategy is to protect and refocus. Protect and refocus means this is a column which is telling us, or which is simply alarming us, that we are lacking in somewhere in terms of our promotions, in terms of our product, service, innovations, creativity, or something with which we are not able to capture, or with which we are not able to retain our existing customers. So, protect and refocus means we have to manage for current earnings and defend the strength also. Then, the one more strategy is selectivity for earning. Selectivity for earning means we have to protect the existing programs as well as investments in portfolio segments only. Then again we have one more strategy, that is to build selectively means specialize around limited strength. When we are having some limited resources, or when the strategic business unit is not performing very well in the market, then what we can do is we can go for limited strength. Then seek ways to overcome the weakness. Whatever weaknesses we have identified in terms of our product or services, or in the overall performance of the strategic business unit, we have to identify those weaknesses and overcome those weaknesses. Then only we can change ourselves, or we can overcome from those weaknesses. Then withdraw if indication of sustainable growth are lacking. This is a very good strategy. Means if we think that we are not able to overcome the weaknesses, then the best possibility is we have to come back and plan again what more better we can do. Now, coming on to the red one, the last three cells of the matrix, these red indicates disinvestment as well as harvest. Disinvestment and harvest means here you can simply say the company's strategic business unit is not performing very well for a continuously long duration of time, and that performance can be in terms of profitability, in terms of product development, in terms of retaining the current market share, or similar activities like research and development activities are also lacking for a long duration of time. So we can plan, or we can have different strategies for these red steps also. These strategies can be, we can go for limited expansion for harvest. Limited expansion for harvest means look for ways to expand without high risk. Means we have to avoid all those planning areas where we will be getting more risk from the market or from the competitors. Then we can go for one more strategy, that is manage for earnings. Manage for earning means protect position in profitable segments only, upgrade the product line, then only we can improve our existing performance and minimize the investment and try to maximize the return which we are getting from the market. We can have one more strategy, that is harvest. Harvest means when we are in the last red or the darkest red cell, which is simply the alarming position for any strategic business unit. Harvest means sell at times that will maximize cash value. Means we have to sell the strategic business unit, but before selling the strategic business unit, we have to identify which time is best suitable to harvest. So we can go for that time when we will be getting maximum cash value. Then cut fixed cost and avoid investment meanwhile. Meanwhile means till we are not able to sell on maximum value, what we can do is cut the fixed cost and avoid further investment so that we can retain the correct position. Therefore, today we have discussed BCG matrix as well as G matrix for portfolio analysis or for analyzing the strategic business units of a company. And by discussing these two models, we have come to the conclusion that General Electric model is much more beneficial and provides concrete results when we are analyzing a portfolio matrix. This is all for today's session. Have a nice day. Thank you.